Hello again, and thanks for watching. Thanks for tuning in again this week. My prediction is that interest rates won't be getting cut in June, and real estate won't be going to the moon like some of those TikTok realtors will have you believe. So, interest rate announcements are supposed to be reactive. They react to the markets in what's needed at that time. Now, prior to the rate hikes, it was 11 months of inflation above 3% before the Bank of Canada did their first rate hike. Now, many would say they were late to the game, but if you think that inflation hits 2.7 and they're going to cut right away in June, you're sadly mistaken, in my opinion. And although we're quickly headed in the right direction for interest rate cuts, we're not quite there yet because there's still one big problem. Now, before I get into that one big problem, let's start with all the rest of the criteria that the Bank of Canada will be looking at before they consider any rate hikes or rate cuts or whatever the case may be. So first is unemployment. Unemployment's currently sitting at 6.1% from the last numbers we had. I believe that was in April's unemployment number. And you can see it looking at this chart, it's historically very low. It is rising very quickly, and be assured the Bank of Canada is watching this very closely, but we're not there yet. Next is the overall stock market. The TSX and even the Dow Jones, I know that doesn't really matter to us in Canada, but the TSX is at an all-time high. Be assured the Bank of Canada is paying attention to overall asset prices and, of course, asset price inflation. Next is the mortgage arrears or mortgage defaults in Canada. This is part of my home buying recipe. They are trending up very quickly, but they're still at relatively low levels. The Bank of Canada, they look at this. It's not in the range where they're in trouble yet. They don't want to see it in major trouble, but they need to see it higher than it is now. And be assured they're watching this metric also. Moving on to the house prices. Now, CREA just released the April data, and we're currently sitting at $703,000. One thing I wanted to point out on this chart is we're still at very high price points for house prices. And of course, that affects affordability and inflation and shelter costs, which we will get into in a minute. But looking at this chart, it looks like we may have peaked in April. Again, I did call that we had an early spring market this year. And in my area, we peaked in March. And nationally, it looks like we're rounding off at the top. We're probably at the peak or very close to it. So one of the things I wanted to point out on this chart was I drew a line, and then we did reach our peak this year. We are lower than the last 3 years. We're lower than 2021, a lot lower than 2022, and of course, lower than last year. Last year was $728,000. In 2021, I think it was around 715 or so. I'll put the number on the screen here. And of course, 2022, we were 816,000. We're now sitting at 703, and it looks like spring is over for most places. I know there's many places like Calgary and the East Coast that have had stellar months and reaching all-time highs, but their all-time highs are a few thousand over their last all-time high. And of course, looking at the April data, prices didn't shoot up, taking into consideration those places affecting the upward trend in prices. And of course, I do have to touch on this updated chart pattern. If you have been watching, I did do some patterns a few videos ago. We are now in a bearish pennant, which means it breaks to the downside. And it is actually a perfect bearish pennant there. I'm not going to bore you with the CREA stats this week, but I did summarize it a few days ago on X. So here they are. Inventory is up 4.2 months. It was currently sitting below 4 last time we checked. Sales are down 1.7% month over month from March to April, which is a huge signal to the market that sales are really slowing. Affordability is out of reach for too many Canadians. The average price didn't move much. It was only up 0.7% month over month. And again, this is with all those price gains in Calgary, Quebec, and the East Coast. Year over year, though, the average price is now down 1.8% or $13,000 year over year. So we're starting to see year over year price declines now. And the sales to new listings ratio is at 53.4%. It is down from the previous month. It currently puts us in a balanced market. Okay, back to the interest rate topic. So inflation is currently sitting at 2.7%. It was just released today. Of course, I'm sure anyone that watches this kind of stuff has already heard the news. It's still at the high end of the target range. The target is from 1 to 3%. The Bank of Canada likes to keep it in. It just doesn't get into that range and they cut right away. Remember, it took 11 months, over 3% for them to hike. They're not going to cut in just 3 to 4 months of it being below 3%, and which is the high end of the range. One thing I do want to point out about interest rate announcements is that the Bank of Canada, their goal isn't to just set interest rates. Their goal is very clear. Here it is on their website, is displayed prominently and clearly at the top. We are Canada's central bank. We work to preserve the value of money by keeping inflation low and stable. Now, I'd say they've done a very bad job in the recent years of keeping inflation low and stable. So again, they're not in the position where they can just cut rates at the first sign it's possible. Lastly, another major criteria that the Bank of Canada looks at is the GDP. Here is the quarterly GDP growth, the quarter over quarter GDP growth. And you can see it has come down. We've had some negative growth in Q4 of 2022, then positive growth early on in 2023, followed by a little bit of negative, one negative quarter, back to positive. And of course, this year has started off in positive territory. So we're not seeing these negative GDP numbers that the Bank of Canada looks at to say, okay, we need to stimulate the economy. We need to cut interest rates further. They're not doing that. They're not seeing it. Here's a recent article from Desjardins. Canada real GDP starts 2024 with a bang. And they're talking about 0.6% up just in 1 month in January. So we're not going to see those 2 consecutive quarters. That signals a recession. It's not here yet. So the Bank of Canada is really not in the position to justify an interest rate decrease or cut at this point. So in my opinion, there's two scenarios going forward. So the first scenario is the weak and spineless decision to cut early, too early. Maybe it's July. I'm not saying it is too early in July, but it could be. If we're not ready for a rate cut in July, asset prices will increase, real estate, stock markets, and whatever else. Inflation will come roaring back, and they'll be forced to increase rates again, further compounding the problem and making things worse. Now, I do believe the Bank of Canada has learned their lesson over the years. Of course, we're human. We learn. We're hopefully smart enough to pay attention to what's happened in the past and in history. But it's not uncommon to see rate cuts followed by rate hikes. And we've seen it many times in history. All of these red arrows here on this chart shows every time they've cut and they've re-raised shortly after because it was too soon. Now, as I've said, it hasn't happened since around 2000 or so. So they have learned their lesson. But again, looking at interest rates, they've been ultra low. So they really didn't have much place to cut to. But again, I sure hope the Bank of Canada and people making the decisions are paying attention to history and what happens when you do cut too early. Now for scenario number two. They do their job like good employees of the Bank of Canada. They wait until inflation is sustainably back at 2% for many months, at which time we will likely be in some sort of recession, whether it's a soft landing or a hard landing. Asset prices will decrease. Housing prices will soften or decrease or crash, whatever the case may be. And a year or two later, we will enter the recovery part of the cycle. And of course, things will turn around. So here's the big problem we're faced with now. Looking at the inflation numbers that came out today, you can see shelter is 6.4%. So shelter is the biggest part of the inflation basket of goods. And it's also the biggest lingering factor in the inflation numbers. It's 6.4%. Everything else has come down to within some sort of reasonable range. I'm guessing that the ones that are in the negative, household operations, furnishings and equipment, and clothing and footwear, are things that people are sacrificing on to pay those higher shelter costs, just like they have cut back on recreation, education, and reading. So although inflation has come down to 2.7%, it's not a balanced basket of goods. People are sacrificing some things to pay for shelter, obviously, because shelter is still too high. And we all know that shelter and housing in Canada makes up a major part of our economy. So it is probably the number one thing that the economists and the Bank of Canada look at in this basket of goods. And it's not where it needs to be right now. So at the end of the day, inflation is still too high. It's at 2.7%, which is still at the high end of the target. Unemployment is rising, but it's not where it needs to be. Asset prices are at all-time highs. GDP is positive and will remain positive for the first quarter of 2024, and we're not in a recession yet. And mortgage arrears, although climbing quickly, are still relatively low. As previously discussed, when things change, they do change quickly. But as for interest rates, we're just not there yet. We're not ready for the first cut. As always, let me know what you think in the comments. I do enjoy reading the comments every week. And until next time, I'll see you then.